Rising home prices and rising mortgage rates. What can you do? So nobody knows for sure what's going to happen to the housing market. Some people are already predicting a crash. So if you ask these so-called experts if they saw these kind of high prices a few years ago, they would all say no. They would not see this kind of price rise so quickly as being sustainable, and they still do not. And they are predicting there's going to be 15 to 20% crash. However, there are many factors at play. There's an artificial price squeeze right now. There's also a price squeeze in the rental market because of the same people who are causing this artificial price squeeze. And there's rising interest where we saw mortgage rates go up from 2.6% last summer to 5.3% this year. So let's talk about all of that and what your options are. House prices are a function of supply and demand. So let's talk about what's impacting the supply and demand. I can truly empathize with the people who are feeling the pinch right now because I'm also in the same boat as them. And as we sold our house in Massachusetts in August of 2021, and between now and then, the prices in Florida have boomed.
Almost every conversation that I've had over the past decade is, well, one, there's this fear that we might find ourselves in another crash, and buyers don't want to be the ones holding the bag in the middle of that transition of a shifting market.
If a housing bubble were to happen, it would mean that a very large portion of Americans' wealth are tied up in risky assets, and they could lose a lot of their wealth as soon as those home prices drop.
So is America currently in another housing bubble?
So first thing that's impacting the house prices is an artificial price squeeze. This price squeeze has been orchestrated by institutional investors. They're called real estate investment trusts, or REITs. Recent data published in March shows that 1.6 million homes sit vacant in Florida alone. They have artificially created a low inventory. What it essentially doing is a price squeeze based on ultra low inventory. They put out only 1 or 2 homes per month just to let the prices keep rising. If property prices are going up by 22% and their cost of capital is around 2.2%, they're getting a 10x return on their investment. That is a tremendous amount. And they will keep doing it even if the rates rise just a little bit. Second thing we need to talk about is rising rent. These institutional investors have stepped up their game in the rental market also. They own a lot of buildings and complexes, not just in South Florida, but also across the nation. They have gotten together and figured out that they can keep pushing rents higher and higher. People are getting displaced because of this reason in many cities. Now, people have to decide between paying a higher rent or buying an even more expensive house. Now let's talk about things that can slow down these rising prices. First, there's new housing starts. New permits data show that a lot of new housing starts that have been stopped during the pandemic are going to come online between the summer of 2022 and 2024. It takes a while to build new houses. During the pandemic, the housing developments had stopped. This had made things much worse for the home prices. However, if you dig deeper into these new houses, they seem to be on the high-end side. It will not alleviate the pressure from the first-time home buyers. It will trickle down and help out a little for sure, but not directly. Let's talk about affordability ceiling. Just because mortgage rates go up and we hit an affordability ceiling from the buyer side, it does not mean prices are going to come down. They may just plateau off. Even if prices come down 15% and your mortgage rates have gone up 50%, which is like going from 4% a rate to a 6% rate, are you really saving money? You may end up in a place where it's even less affordable despite the price cut. Natural growth in demand. Every year, there's a natural growth in demand as new buyers come into the market. More people come of age where they have gotten jobs and gotten married and need to purchase a home. There's already a demand backlog piling up where people have not been able to buy a house in 2020 or 2021. Many of these people have been saving up more and more money to buy a house. Some have even moved back with their parents to come up with the down payment. Impact of rising rates. With rising rates, it may cause the investors to release more house into the market, and maybe all at once, and cause a crash. That's possible. However, there's a tremendous inflow of new investor cash coming in. They have been putting up great returns, and it is only attracting more and more new investor money to come in. Housing crash. This is a real concern, and this is how it happens. People are still buying houses now with only 3% down with the help of the federal government like FHA loans. Even some conventional loans are only 10% down. So if house prices come down only 15%, for example, and there's a recession and people don't have money to pay for their mortgages, they cannot even sell their houses at that point because they won't have enough equity to pay down their mortgage and pay back the bank. These people will just hand their keys back to the bank and walk away, which is called a foreclosure. If there's a large amount of foreclosure, it can cause a severe sharp turn in the housing market. So here's the bottom line, guys. For people who are financing their houses with 80% loan, it is just a trade-off between a higher home price versus a higher mortgage interest rate, where ultimately your monthly payment may end up rising because the rates are a lot higher than the prices of the homes have come down. So unless you're a cash buyer, it's just a trade-off, and your monthly payment may be a lot higher in the future. So what are your options and what can you do? Well, there are three things that we can talk about. Okay, one, you can sit out and wait. Timing the market is a risky business. That is not my pick, unless you cannot already afford anything anymore. In that case, your choice has already been made for you. Number two, lower your wish list. Figure out what your priorities are. For example, if it's a space, or is it a location, or is it a view? If you can go from a 2,500 square feet home to a 1,800 square feet home, then do it. You can still buy a house if you make that compromise. If you can go from a beach view condo to something more inland with a lake view, then that is a compromise, but you can still get it done. The third one, a lot of people may not like, is going from a 3-bedroom place to a 2-bedroom. So if your third bedroom was meant to be an office, see if you can work something out where the master bedroom is big enough and you can put the office in there. A lot of times that room is very underutilized anyway. Something more specific to Fort Lauderdale area and Miami, there's not a lot of units out there which are 3-bedroom in the medium price range. So if you're looking for a 3-bedroom condo overlooking the beach, cutting down to a 2-bedroom unit where you're putting the office in one of the bedrooms, that is a compromise many people have to make right now. Number 3, change the type of mortgage you are going to get. Many people get the 30-year mortgage because that is the most conventional thing to do. What that means is your rate is fixed for all 30 years. But you can also get a variable rate mortgage where your rate is only fixed for the first 5 years, 7 years, or 10 years. My wife and I have bought and sold many properties, and we have never stayed in one place for more than 5 years. You can save a ton of money by going from a 30-year fixed mortgage to 7-ARM or a 10-ARM if that makes you feel more comfortable. In 10 years, it doesn't mean your rates are going to automatically shoot up. The variable rate doesn't mean it's going to be a super high. It can be a low rate, and a lot of people who had ARMs actually kept their variable rates. If the rates climb back down anytime within that 10 years, you can refinance it and go to a lower rate. Refinancing will cost you between $2,000 to $3,000 depending on the market you're in and the bank you're doing business with. But that is a viable option when the rates have already gone up when you're trying to buy a house. Another thing you can consider is if you have a great portfolio and your cash has been put away into that portfolio and you don't want to pull that money out right now, in 10 years, your portfolio may be big enough where you can pay down the house. A decade is a very long time, and most people can end up in a totally different financial situation within that time. One thing I would probably emphasize is the worst thing you can do is rushing to buy a house that you cannot afford right now, only to watch the prices come down 20% later on. So this video was more of a discussion and not a direct advice. I hope you found it useful. If you did, please give it a like, and I'll see you in the next one.